Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss looking beyond the major market indices when building a diversified portfolio. This is especially important today given the uncertain market and economic environment. When building a long-term investment portfolio, stocks have historically played a foundational role in creating wealth and helping investors to reach their financial goals. Investors naturally think of the stock market in terms of the major indices like the S&P 500 or the Dow Jones Industrial Average, both of which concentrate primarily on the biggest U.S. companies. While these large cap stocks are certainly important for understanding overall market trends, relying solely on them may cause investors to miss opportunities. So, how can investors broaden their perspective? Two areas that investors should be aware of are small cap stocks and international markets. Each offers distinct characteristics and potential benefits that can enhance portfolio diversification, particularly during periods of market volatility and economic uncertainty. First, let's talk about small caps. Small cap companies typically have market value ranging from a few $100 million to a couple $1 billion. Over the past decade, small caps have lagged behind large cap stocks due to the outsized performance of the largest technology companies. However, the flip side of this coin is that these challenges have created interesting valuation opportunities. Small caps are currently trading at a more reasonable price to earnings ratio compared to their large cap counterparts, with price to earnings ratio of the Russell 2000 well below its 10-year average. Small caps also tend to be more sensitive to the U.S. economy and interest rates compared to large caps. Not only is the economy stabilizing after a rocky start to the year, but the Fed is expecting to continue cutting rates later this year. While this is no guarantee that small caps will outperform in the near term, it is a reminder to diversify across many parts of the market. Next, the major stock indices like the S&P 500 and the Dow primarily focus on U.S. companies. This ignores many other parts of the global market that can help to broaden portfolios as well. In fact, international stocks have performed well this year despite trade uncertainty. International stocks are generally divided into two categories. First, we have developed markets like Europe, Japan, and Australia, which feature mature economies and established market infrastructure. Then there are emerging markets, including dynamic economies like China, India, and Brazil, which offer different growth profiles and regulatory environments. After years of U.S. market dominance, international stocks have actually outperformed this year, with the MSCI EAFE index, which tracks the 21 major developed market countries, has gained approximately 17.5% year to date in U.S. dollar terms. Meanwhile, the MSCI EM index, covering emerging markets, has risen 10%. International stocks have also been trading at much lower valuations than the U.S. markets. Small caps and international stocks are just two examples of areas outside of large U.S. stocks where there are opportunities for diversification. This chart shows how these different asset classes have performed across time. This is not to say that U.S. large caps will become less important. Instead, it's a reminder that maintaining long-term portfolios is all about holding the right asset allocation across all these types of investments. By including more attractively valued parts of the market, we can potentially strengthen long-run risk-adjusted outcomes and take advantage of market opportunities. We hope you found these insights helpful. If you would like to discuss opportunities for diversification in your portfolio in more detail, please don't hesitate to reach out. We look forward to speaking with you.